Ever notice those overlooked spots in your city? The vacant lots you drive past, maybe an old building just sitting there. Well, today on the deep dive, we're digging into why those exact spaces are, frankly, turning into gold mines for real estate investors. We're focusing on urban infill projects. And our guide for this is some really interesting material from Urban Infill, high yield bulk real estate investment. It features insights from Dr. Pooyan Ghamari. He's a Swiss economist and also the founder of the A-Land platform. Right, so our mission here for you is to really unpack why this urban infill thing is attracting so much serious money, institutional capital, and also how technology is shaking things up in this area. Plus, we'll look at the social and economic forces behind it all. Some of those might surprise you. Think of this as your shortcut to getting a handle on a really lucrative and honestly impactful part of the real estate world. Okay, let's start at the beginning. What is urban infill exactly? Basically, it's redeveloping plots within existing city areas, so vacant land, underused sites, maybe even derelict buildings. It's about breathing new life into these forgotten spots right inside the city.
Exactly. And the key difference, is compared to what's called greenfield development. That's when you build on completely new land, usually like on the edge of town.
Right, the suburbs often.
Precisely. Infill, though, it optimizes land that's already in the city, which is scarce. And crucially, it uses the infrastructure that's already there. We're talking utilities, roads, transit.
Ah, okay, so you don't have to build all that new stuff.
Correct. Which makes it a really efficient way to meet the high demand for space in urban centers. And Dr. Ghamari really stresses this point. Strategic infill isn't just construction. It's about aligning urban regeneration goals with the kind of sophisticated investment frameworks that big institutions use.
Investment frameworks.
Yeah, the structured ways they evaluate and manage assets. It makes infill perfect for, well, bulk acquisitions and for diversifying their portfolios.
Okay, that makes sense. Using what's already there, fitting into investment strategies. But here's what I find really interesting. Why are these huge institutional investors, the ones with really deep pockets, so interested in urban infill for bulk investments? It seems like redeveloping existing sites could be tricky, right? More complex.
It can be complex, yes, but the advantages for these big players often outweigh the challenges significantly. Think about it. You get proximity to major economic hubs. That's huge. Plus, development lead times are often shorter because, as we said, the basic infrastructure is usually in place.
So faster from planning to actually generating income?
Potentially, yes. And there's a strong case for faster capital appreciation, too, simply because of urbanization trends pushing property values up in desirable city locations. And buying in bulk multiple sites, large parcels, lets them achieve scale efficiencies. It helps them manage the complexities, like fragmented ownership, much more effectively.
Scale efficiencies, right. Cheaper per unit, essentially.
Basically, yes. And Dr. Ghamari makes a very specific point here. Urban infill often delivers higher yield multiples.
Higher yield multiples, meaning better returns for the money invested.
Exactly. Better returns compared to, say, building sprawling developments further out. And the reason is pretty straightforward. Infill directly meets that intense demand for housing and commercial space in walkable neighborhoods, the places with lots of amenities. That's where people increasingly want to be.
Okay.
And another factor is municipal incentives. Cities often encourage this kind of denser, sustainable development, which can definitely improve the investment numbers.
I'm seeing the financial logic now. The existing infrastructure, the high-demand locations, the potential incentives. But you mentioned complexity earlier, things like zoning, maybe environmental cleanup, dealing with lots of different stakeholders. How are these projects actually becoming manageable enough for these large-scale investments? Is technology stepping in?
Oh, absolutely. Technology isn't just stepping in, it's really changing the game. The inherent complexity of infill practically requires sophisticated digital tools now. You have platforms like A-Land, for instance, providing things like advanced data analytics, tools to navigate zoning compliance.
Okay, cutting through the red tape digitally.
Sort of, yeah. And even using things like blockchain for property records. All of this streamlines the whole process from due diligence and acquisition right through to managing the assets. It makes it much more efficient for bulk investors.
Blockchain for property records. Interesting. What else?
Well, beyond streamlining, there's the really disruptive innovation of tokenization.
Tokenization.
Right.
We hear that term a lot. How does it apply here?
It means taking an urban real estate parcel, or even a portfolio of them, and dividing the ownership into digital tokens on a blockchain.
So you can own like a tiny fraction of a building.
Precisely. Fractional ownership.
Mm-hmm.
This does a couple of key things. First, it creates way more liquidity compared to traditional real estate. Selling a token is usually easier and faster than selling a whole property.
I see. Easier to get your money in and out.
Right. And second, it opens the door to a much wider range of investors. Smaller investors can participate. It kind of democratizes access to these kinds of deals. Dr. Ghamari really emphasizes how these technologies boost transparency, cut down on transaction friction, the costs and delays, and they align perfectly with what global investors now expect, digitally managed assets.
So the money makes sense, the tech makes it feasible, but let's zoom out a bit. Beyond the deals themselves, what are the fundamental economic and maybe social forces really driving this demand? What's the bigger picture here?
Well, the biggest driver is probably the sheer growth of urban populations worldwide. This creates really serious shortages of housing, especially affordable housing, and commercial space in good locations.
Just not enough places for people to live and work in cities.
Exactly. And infill projects are a direct response to that. They help fight urban sprawl, cities just spreading outwards endlessly. Instead, you revitalize dormant lots within the city center. And this inherently aligns with ESG principles, environmental, social, and governance.
Ah, ESG. That's becoming huge for investors, isn't it?
Increasingly non-negotiable for many. So institutional investors are often drawn to infill, not just for the financial return, but because it helps them meet their social impact goals. It's seen as responsible investing.
Okay, so it ticks the financial box and the social responsibility box.
In many cases, yes. And Dr. Ghamari also points to macroeconomic signals, things like rising wages in cities, demographic shifts like smaller households, maybe, and government programs focused on urban renewal. All these trends tend to favor investment in these centrally located infill properties. Plus, the strong transport links, the existing shops and amenities, they all support higher rental income and better long-term stability for the asset.
Making them solid anchors for an investment portfolio.
Exactly. They become compelling portfolio anchors.
Now, something that came up in the material was cause-related marketing. That sounds more like something you'd use for selling, I don't know, coffee or shoes. How does that fit into high-yield real estate? Seems like an odd pairing.
It does sound a bit unusual at first, but it's surprisingly effective in this context. In real estate, cause-related marketing means actively linking an infill development project to a specific social or environmental cause.
Okay, like what?
Well, for example, maybe the project makes a clear commitment to community engagement, or it aims for high green building standards, or includes a significant component of affordable housing. Highlighting these aspects does wonders for the developer's brand equity, how they're perceived, and it boosts investor confidence.
So it attracts people who care about those things.
Exactly. It attracts socially conscious tenants, investors, local authorities, other stakeholders, people who want to be associated with a project that's doing good, not just making money. And there's real evidence for this. Material from Alan's blog, for instance, shows that projects featuring things like urban green spaces, renewable energy, or inclusive design often achieve a premium position in the market.
So doing good translates to doing well financially.
That's the idea. Dr. Ghamari argues that this kind of marketing genuinely elevates the perceived value of the asset, builds loyalty, and ultimately drives better financial results while building long-term trust.
It's about building a better reputation and a better bottom line.
You could put it that way, yes.
Okay, so looking ahead, what does all this mean for the future of investing? Let's talk about crypto and real estate intersecting. Sounds very cutting edge. How is that playing out?
It's definitely one of the most fascinating developments. The convergence of crypto, or maybe more broadly, blockchain technology and urban real estate is genuinely reshaping how people invest. We saw early examples like Gold, which used blockchain to kind of revolutionize gold investment.
Right, making gold easier to trade and own digitally.
Exactly. And that concept is now a major inspiration for real estate tokenization, especially for these complex, large-scale urban infill deals we've been discussing.
So applying that digital fractional model to property.
Yes. And Dr. Ghamari's view is that using digital currencies and blockchain for ownership can unlock massive amounts of liquidity in what's traditionally a very illiquid asset class. It lowers the barriers to entry, making it easier for more people to invest.
Right, not just the huge institutions.
Potentially, yes. And it can make cross-border investments much smoother. This could significantly expand participation from both big institutions and high net worth individuals globally. Essentially, these digital tools promise greater market efficiency and help real estate align better with the whole digital economy.
Fascinating stuff. Okay, let's bring this home for the listener. For you listening right now, maybe you're thinking about this space. Maybe you're just curious about how these ideas apply more broadly. What are the key actionable takeaways here? How can someone apply this thinking, even if they're not managing billions?
Well, based on the source material, There's some clear steps or principles to understand. First, it's about identification. Learn to spot those clusters of underused urban parcels. Look for areas with compatible zoning, areas that seem ripe for development potential.
Develop an eye for opportunity within the city.
Exactly. Second, understand the power of platforms. Tools like ALAND offer comprehensive due diligence, zoning analysis, transaction support. Leveraging technology is key, even on a smaller scale. Third, think about incorporating those ESG frameworks and maybe even cause-related marketing. Even in smaller projects, demonstrating sustainability or community benefit can differentiate your development and potentially attract premium value,
Stand out by doing good.
essentially. Fourth, keep an eye on tokenization models. Even if you're not doing it yourself, understand how it might impact liquidity and ownership structures in the future, maybe even for smaller bulk deals. And finally, monitor the right things. Key performance indicators aren't just about rent. Look at rental yields, yes, but also absorption rates, how fast things get leased or sold, and also community engagement metrics, brand perception. These give a fuller picture of success and impact.
That's a really practical list. So we've journeyed from seeing, forgotten city plots to understanding them as these sophisticated, high-yield investment opportunities. And it's all being driven by technology. And interestingly, this growing focus on social responsibility feels like a fundamental shift.
It really is. And perhaps the final thought for you to consider is this convergence of technology, sustainability goals, changing city populations. It isn't just changing how we invest in real estate. It's actively reshaping the physical fabric of our cities for the future. So what does that mean for the communities actually living in these redeveloped areas? And how might that influence the next wave of urban transformation we'll inevitably see?